Hello and welcome to the show. It is great to have you with us. Just as investors get used to calmer waters in the markets, the Dow Jones Industrial suffers the biggest fall since January as trade wars rear their ugly head again. Here with his take on what investors should look for, as well as the biggest stories this earnings season, is Ben Gossack. He's portfolio manager of the TD Active Global Enhanced Dividend ETF, and it is great to have you here.
Thanks for having me back.
I want to talk about the earnings before we get there. You know, tweets, tariffs, Trump, it all begins again.
Yeah, I mean, you could look at it kind of a couple ways. The market's been up about 23% since the bottom in December. And so since Trump's tweets, we're only down about 2%. So, I mean, we're kind of due for a little bit of pullback. But we've talked many times on your show about the world, or investors looking at the world in sort of a glass half full, glass half empty lens, and it's very easy to focus on the glass half empty. And the three things that were bothering the market was maturing economic cycle, trade uncertainty, and the Federal Reserve. And so I'd say since December, we sort of resolved some trade uncertainty that we'd get a framework. The Fed has sort of moved to the sidelines. And we do have a mature economic cycle, but we don't have anything that's approaching deceleration. And so Trump's tweets remind us that there was a bit of expectation that we were getting closer to a framework, and that might be a little bit ways off.
Yeah, we got some news, of course, with China now saying countermeasures, and we'll see. But again, we're near the deadline. This always happens near the deadline, so you have to kind of watch this stuff.
Right.
I know one thing, though, that what happens, of course, is the politics, make the headlines. But in the meantime, we've had an earnings season that's come out. So I want to get your take just on how those earnings were looking overall, because I think the bar was actually pretty low going into this, wasn't it?
Yeah. So I mean, all this tweeting about tariffs sort of overshadow actually what's been a really good earnings season. I think we need to put this in context. So, revenue grew about 2%, and earnings per share grew about 2% as well. And you'd say those don't seem like really big numbers, but we're comping quarters that had a revenue growth of 8%. Yep. And earnings per share growth of 26%. Now, some of that came from the tax reduction, but you're looking at about 18% core growth. So we're due for a bit of slowing just because we're comping big numbers, but they have come out well ahead of expectations. And there's a couple of sectors that have been interesting highlights.
Let's run through some. Technology is always one that, of course, it's been leading the markets for so long. What did we see out of the tech companies? Yeah,
so tech's really important. It's the biggest sector. I think we saw two different speeds. So if you break it down into software companies, if you think about Microsoft, Salesforce, ServiceNow, have done really well. What's held back the technology sector has been hardware. And when we say hardware, we're on sort of a back end of a slower iPhone cycle. So Apple coming out, revenue down 5, earnings per share down 10. Doesn't seem too terrible, but that's the second largest stock in the index, so it does weigh down on the market. Mm-hmm. And then we've talked about this, about a semi-cycle. So we've had a slowdown since the summer of last year, and so that's playing its way through, and we're looking for about a bottoming very soon.
How did, if you look at media comms, I mean, I guess I want to get to Google. Is Google a media comms company? Is that how
so under the new reclassification, Google, Facebook, AT&T, Verizon, Comcast, and Disney are all in sort of one little sector. I'd say interesting reaction to Google. So if I told you that Google put up 19% revenue growth, given the amount of revenue that they generate, the billions and billions of dollars, you'd say that'd be pretty good. But this is the first quarter in several years that revenue growth wasn't above 20%. And so that was a bit of a surprise for a lot of investors, and so that stock was down about 8%. But going through the earnings, there didn't seem to be anything about a deterioration in the business. On the flip side, Facebook was up about 6%. And so they had sort of telegraphed that they would see revenue and earnings slow because they're changing their communication model rather than public posts, more of a private communication between people. But what was surprising about Facebook was the resilience of the people that go on that platform. So given all the headlines and worries about fines, the monthly activity was up about 8%. And so that's why the stock sort of improved.
Inertia. People are there. They don't want to move. I think that always speaks to a lot. Okay, industrials, 3M, not so great.
Yeah, so it's funny. So 3M, a big bellwether, down 13%, you'd say, okay, maybe this isn't such a good earnings season. And so, 3M sells to everybody, but it overshadows what actually was really good earnings in industrial. So if you look at aerospace companies, you look at the rails, you look at defense, all had really good quarters. What 3M that's different than the other industrials. It's a bit more tied to shorter cycles. And so when they say automotive was slowing down, when they say that electronic manufacturing, it's almost coincident with the data that we see. So it doesn't mean that there's anything in particular bad that's going on. It's just it's caught closer to sort of shorter cycles.
Got it.
I'd say the sector that is the biggest surprise to me is healthcare.
Yeah.
Healthcare stocks were up about 5% on revenue. They grew their margins. They grew their earnings per share about 10%. You think that the market would reward healthcare stocks, but given the sentiment that's going on right now in terms of the upcoming 2020 U.S. Presidential elections, healthcare is actually the stock that's lagged the most on a relative basis.
We've got a chart here. We can show kind of where we go from here, and you've got to look at kind of the leading, I say, transitioning and lagging sectors, and what happened for the first quarter. But I mean, looking ahead, how do things look?
Yeah, so on a valuation basis, the stock market is trading about sort of 15 times 2020 earnings, and we're trading near highs. And so what's leading the market is the tech sector, and then funny enough, utilities and REITs. They don't typically go hand in hand, but we're in a very lower interest rate environment, and so utilities and REITs tend to do better. But the way I like to think about it in terms of leading relative to the market high that we saw in September and the market high that we saw in February. Transitioning means they're doing better than the market high that we saw in September, but they still haven't surpassed their market highs in March, but that's communications and staples are story moving through. I think what really gets this market going beyond 2,900, again, looking past the sort of tariff noise that we see this week, is cyclical sectors like financials, industrials, that still haven't cleared their September highs or their March highs. U.S. large cap banks reported they put up pretty good numbers. JP Morgan's starting to push a little higher, so that will start to move things. And then industrials as well. It'd be good to see those stocks move higher, and that should keep the market going even higher than where it is now.